Marcus and Ethan are both 35 years old. They both live in Denver. They both earn $85,000 a year. They both spent the last decade building the exact same emergency fund, the exact same retirement account, and the exact same $100,000 pile of extra savings. Then interest rates jumped, and both of them decided it was finally time to make their money work harder. Marcus bought long-term bonds because he wanted to lock in what looked like an attractive yield for years to come. Ethan kept his cash in short-term treasury investments, convinced that flexibility would always beat commitment. They both think they made the smarter move, and they're both missing something that completely changes the story. Because understanding money isn't really about stocks. It isn't really about savings accounts. It isn't even about interest rates. It's about bonds. Once you understand what bonds actually are, you'll start seeing why mortgages, savings accounts, stock prices, and even recessions all move the way they do. By the end of this comparison, the gap between what Marcus believed and what actually happened won't just surprise you. It'll completely change the way you think about money. To make this fair, let's give both of them identical starting conditions. Same age, same city, same salary, same tax bracket, same $100,000 available to invest. Neither one touches the money for living expenses. They simply choose different bond strategies and let time do the work. No tricks, no lucky timing, just two different decisions. Marcus looks at the market and sees 20-year treasury bonds yielding about 5%. He thinks 4.5% guaranteed for 20 years? That's better than the tiny yields we had a few years ago. Rates probably won't stay this high forever. So he buys $100,000 worth of long-term treasury bonds paying approximately 5% annually. Ethan looks at the same market and reaches the opposite conclusion. He buys short-term treasury bills through a treasury bill ladder, rolling them over every few months. His average yield starts around 3%, just slightly lower than Marcus's. He knows that yield could rise or fall depending on future interest rates, but he likes having access to his money without taking much price risk. At first glance, Marcus seems like the winner. His yield is slightly higher. His income is predictable. He doesn't have to think about reinvesting every few months. Meanwhile, Ethan's strategy feels boring. Every few months he simply renews treasury bills. Nothing exciting happens. No impressive statement arrives showing a giant gain. No story to tell friends. Feelings and math are two very different things. Because here's what almost everyone gets wrong. When most people hear the word bond, they imagine a savings account with a better interest rate. That's not what a bond is. A bond is a loan. You're lending money to someone else. Sometimes that's the U.S. government. Sometimes it's a corporation. Sometimes it's a local city building roads or schools. In return, they promise to pay you interest and eventually return your original investment. Sounds simple. But one number changes everything. Interest rates. Imagine buying a bond today that pays 5%. A year later, brand new bonds suddenly pay 6%. Would another investor pay full price for your older bond paying only 5%? Probably not. To convince someone to buy yours instead of the new one, you'd have to sell it at a discount. That's why bond prices fall when interest rates rise. Now flip it. Suppose rates fall from 5% to 3%. Suddenly your older bond paying 5% looks incredibly attractive. People are willing to pay more than face value for it. Your bond price rises. That's the relationship most people never learn in school. Rates up, bond prices down, rates down, bond prices up. And that one relationship quietly affects almost every corner of the financial world. Mortgage rates, car loans, business borrowing, stock valuations, savings account yields, even the value of pension funds. Understanding bonds isn't about becoming a bond investor. It's about understanding the engine underneath the financial system. Let's fast forward 1 year. Marcus receives approximately $4,500 in interest payments. Exactly what he expected. His bond is still paying him on schedule. Everything feels great. But interest rates across the economy have climbed another full percentage point. New 20-year treasury bonds now yield around 5%. Marcus still owns a perfectly good bond. The problem is that nobody wants to pay full price for yesterday's lower yield. On paper, the market value of his bond falls by roughly 13% to 15%. His $100,000 position is now worth about $86,000 to $87,000 if he needed to sell. He doesn't lose income, he loses flexibility. Meanwhile, Ethan's treasury bills mature. He receives roughly $4,300 in interest during the year, slightly less than Marcus. But instead of holding an older bond with a lower yield, he simply reinvests into the new, higher rates. His principal remains almost exactly $100,000. His next round of treasury bills now earns close to 5%. Marcus looks richer from the income. Ethan quietly improves his future income. Very different stories, very different math. Now here's where people usually stop thinking. Marcus says, "I'm never selling anyway." That's a perfectly reasonable response. If he truly holds until maturity, he'll continue receiving his interest payments and eventually get back his full principal. But life has a habit of interrupting long-term plans. A business opportunity appears. A family emergency happens. Someone wants to help a child buy their first home. Retirement comes earlier than expected. Suddenly, flexibility has value. And flexibility always has a price. Let's move to year 3. The economy slows. Inflation begins cooling. The central bank starts lowering interest rates again. New long-term treasury bonds now yield around 3.8%. Marcus's older bonds paying 4.5% suddenly become more attractive. The market value of his investment climbs back above what he originally paid. Instead of sitting near $86,000, it's now worth roughly $107,000. He has also collected approximately $13,500 in total interest payments over 3 years. On paper, that's about $120,500 of combined value. Sounds fantastic, until you subtract everything else. Inflation averaged close to 3% during much of this period. After taxes, assuming a combined federal and state tax rate near 22%, Marcus keeps closer to $10,500 of that interest rather than the full $13,500. His purchasing power hasn't grown by the headline number. It's grown by much less. Ethan tells a different story. His treasury bills earned around 3% during the first year, then approximately 5% after rates increased, before gradually declining as rates fell again. Across the 3-year period, his average annual yield lands around 4.8%. His account grows to approximately $114,700 before taxes. After taxes, his gains are also reduced. But because his investments matured frequently, he never experienced the dramatic swings in market value Marcus watched on his account statement. Neither strategy is obviously winning anymore. Marcus benefited when rates eventually fell. Ethan benefited when rates initially rose. Both earned respectable returns. Both experienced trade-offs. And this is exactly why people misunderstand bonds. They don't ask the first question that actually matters. Not, what's the yield? Not, what's today's interest rate? The first question is much simpler. How long are you lending your money away? Because once you know the answer to that question, you can start predicting something far more important than next year's interest payment. You can start predicting how sensitive your money is to everything else happening in the economy. 5 years have now passed. Marcus hasn't touched his investment once. Every 6 months, another interest payment arrives exactly as promised. That's one of the biggest reasons people love long-term treasury bonds. The payments don't care whether the stock market is celebrating or panicking. They simply show up. By the end of year 5, Marcus has collected about $22,500 in total interest. His original $100,000 principal is still intact if he holds until maturity. But here's the part most investors overlook. His principal isn't actually worth $100,000 today. It's worth whatever another investor is willing to pay for a bond paying 5%. At this point, long-term treasury yields have settled around 7%. That means Marcus's bond is now more valuable than when he bought it. Its market value has climbed to roughly $112,000. Add the interest he's received, and his total economic value is about $134,500 before taxes. On paper, that's impressive. Sounds great until you subtract everything else. Federal income tax on Treasury interest still applies. Assuming a 22% federal tax bracket, Marcus owes roughly $4,950 on the interest payments he's received so far. Treasury interest is generally exempt from state and local income taxes, but federal taxes still reduce what actually lands in his pocket. Inflation also matters. If inflation averaged about 8% over those 5 years, the purchasing power of that $22,500 in interest isn't the same as it looked on paper. Nominal returns tell one story. Real returns tell another. Meanwhile, Ethan's Treasury bill ladder has quietly adapted every few months. When rates rose, his income increased. When rates later declined, his new investments earned less. Over 5 years, his blended annual return averages close to 7%. His account grows to roughly $125,800 before taxes. Unlike Marcus, he never experiences a 15% swing in market value. Every few months, his investments mature. Every few months, he has a decision: reinvest, spend, or move somewhere else. That flexibility doesn't produce headlines, but flexibility is valuable. Now imagine something neither of them expected. A recession arrives. Companies begin laying off workers. The stock market falls 28%. Suddenly, Marcus and Ethan aren't thinking about maximizing returns anymore. They're thinking about cash. Marcus still owns an excellent long-term treasury bond. The U.S. government is still making every interest payment exactly on schedule. Nothing is wrong with the bond itself. But if Marcus suddenly needs $60,000 for living expenses before maturity, he may have to sell part of his investment at whatever the market price happens to be that day. Fortunately for him, rates have fallen during the recession. His bond price has increased. He can sell without taking a major loss. But imagine the opposite timeline. Imagine rates had continued rising instead. He might have been forced to lock in a significant capital loss simply because life didn't wait 20 years. Ethan doesn't have that problem. Every few months, another treasury bill matures. Cash simply appears. No selling required. No guessing what today's market price might be. His strategy quietly builds liquidity into the investment itself. This is the flip point. At the beginning of the story, Marcus looked smarter. He locked in a higher yield. He avoided reinvestment risk. Everything felt predictable. Then rates rose. Ethan looked smarter. Then rates fell. Marcus looked smarter again. Neither one was consistently winning, because yield wasn't the whole game. Duration was. Duration is simply a measure of how sensitive a bond's price is to changes in interest rates. You don't need complicated formulas. Here's the plain English version. The longer you lend your money, the more dramatically your bond's price reacts when interest rates move. That's it. A treasury bill maturing in 3 months barely moves. A treasury bond maturing in 20 years can swing more than 15% or even 20%, depending on how far rates change. Same borrower, same government, completely different risk. Now let's fast forward to year 10. Marcus has collected roughly $45,000 in total interest payments. Interest rates have stabilized around 4%. His bond's market value sits near $105,000. Combined with his interest payments, his total value is approximately $150,000 before taxes. Not bad at all. Ethan's rolling treasury strategy produces a similar long-term average yield of around 4%. 5%. His account grows to roughly $155,000 before taxes because he benefited from several years of elevated short-term rates before they gradually normalized. Notice something interesting. The gap between them isn't enormous. $5,000, maybe $6,000. Certainly not the life-changing difference most financial influencers would have you believe, because the biggest lesson isn't which investment won. It's understanding why they perform differently. That's where real financial literacy begins, and that's exactly what nobody talks about. Everyone loves quoting the yield. 4%, 5%, 6%. They'll tell you exactly what they're earning. They almost never tell you what they're risking to earn it. Let's unpack the hidden layers. First, duration risk. This is the silent price tag attached to every long-term bond. Marcus accepted the possibility that his bond's market value could temporarily fall 15% or more if interest rates rose sharply. Nothing about the bond itself changed. Only interest rates changed. Second, reinvestment risk. This is Ethan's hidden cost. Suppose short-term rates eventually fall to 2%. Every treasury bill that matures now has to be reinvested at that lower rate. His income gradually shrinks. Marcus doesn't have that problem. His 5% coupon continues arriving regardless of what happens to new interest rates. Third, inflation risk, a bond paying 5% sounds wonderful. Unless inflation suddenly averages 5%. Now your purchasing power is actually declining even though you're receiving every promised payment. On paper, that's a positive return. In real dollars, it isn't. Fourth, taxes. Treasury interest is subject to federal income tax. Corporate bond interest is generally taxable at both the federal and state level. Municipal bonds can sometimes be exempt from federal taxes and, in certain cases, state taxes as well. The investment with the highest yield isn't always the investment with the highest after-tax return. Finally, opportunity cost. This is the invisible number almost nobody calculates. Suppose Marcus locks his money away at 5%. 3 years later, an incredible investment opportunity appears. Maybe a rental property selling well below market value. Maybe a business acquisition. Maybe stock prices have fallen dramatically. His money is tied to a long-duration investment whose value depends on current interest rates. Ethan has cash becoming available every few months. Opportunity cost rarely appears on investment statements, but it absolutely affects long-term wealth. And here's something backed by real data. According to the U.S. Department of the Treasury, Treasury securities are backed by the full faith and credit of the United States government, making them one of the lowest credit risk investments available. That doesn't mean they're risk-free. It means the primary risk isn't whether you'll get paid. It's how changes in interest rates affect the value and purchasing power of your investment. Those are two completely different risks, and confusing them is where millions of investors go wrong. Because when people say bonds are safe, they're usually talking about credit risk. When someone else says, I lost money in bonds, they're usually talking about interest rate risk. Both statements can be true at exactly the same time. That's the hidden math almost nobody explains. If I only showed you the downsides of long-term bonds, I'd be doing exactly what every cash is king influencer does. And if I only showed you the benefits of locking in higher yields, I'd be doing exactly what every bond salesman does. The truth is more interesting than either side wants to admit. Marcus's strategy has real strengths. If interest rates fall significantly after he buys his bonds, the market value of those bonds can rise dramatically. That's exactly what happened during several periods over the last few decades. A long-term treasury purchased before a major decline in rates can generate returns that are much higher than the coupon alone would suggest. Marcus also never has to worry about reinvesting every few months. His income is predictable. Every payment is known in advance. For retirees who depend on consistent cash flow, that predictability has real value. But it comes with trade-offs. His money is tied up for much longer. If inflation unexpectedly jumps from 3% to 6%, his fixed interest payments don't increase. If rates rise sharply, the market value of his bond can fall substantially even though the U.S. Treasury continues making every payment exactly on schedule. Ethan's strategy has different strengths. His principal remains remarkably stable because his Treasury bills mature so quickly. Every few months he can adapt to whatever the economy is doing. Higher rates, his income rises. Need cash? His investment naturally matures. A better opportunity appears? He doesn't have to sell anything. But Ethan pays a different price. If interest rates fall from 5% to 2%, every new Treasury bill he buys earns less than the previous one. His income slowly declines. He's constantly exposed to whatever today's interest rate happens to be. That's reinvestment risk. So when does Marcus's strategy actually win? First, when you believe today's interest rates are unusually high and likely to fall over the coming decade. Second, when you know you won't need the money before maturity. Third, when your primary goal is dependable income rather than maximum flexibility. And fourth, when you're matching future expenses, like retirement income, with future bond payments. Now, when does Ethan's approach clearly win? First, when interest rates are expected to remain elevated or continue rising. Second, when you'll likely need access to your money within a few years. Third, when you want the flexibility to move into other investments as opportunities appear. And fourth, when uncertainty itself is your biggest concern. Neither strategy wins all the time. Markets don't work that way. Now let's zoom all the way out. 20 years pass. Marcus reaches the maturity date of his treasury bonds. Over those 2 decades, he has collected approximately $90,000 in interest payments. His original $100,000 principal is returned in full by the U.S. Treasury. Ignoring taxes for a moment, his total cash received equals about $190,000. After paying federal taxes on the interest over those 20 years, assuming an average 22% bracket, his after-tax interest is closer to $70,000. That puts his total after-tax proceeds around $170,000, not including the impact of inflation. Meanwhile, Ethan's Treasury bill ladder has been rolling continuously. His annual yield changed dozens of times. Some years he earned over 5%, other years he earned closer to 2%. Across the full 20-year period, let's assume his blended annual return averages approximately 4%. His investment grows to roughly $236,000 before taxes if all interest is reinvested. After federal taxes on the interest earned over time, his ending value is closer to about $210,000. On paper, Ethan finishes roughly $40,000 ahead. Sounds decisive, until you ask the next question. What if interest rates had followed a different path? Suppose rates had fallen quickly after year 1 and stayed low for the next 19 years. Marcus's locked-in 5% coupon would suddenly look brilliant. His bond prices would have appreciated significantly early on. Ethan, meanwhile, would spend almost 2 decades reinvesting at much lower yields. The winner flips, again, because interest rate paths matter more than almost any headline you'll ever read. Now here's the lever that changes everything. Neither Marcus nor Ethan ever added another dollar. What if Marcus simply invested an additional $200 every month into short-term treasuries after purchasing his long-term bonds? Over 20 years, assuming roughly a 5% annual return, that extra contribution alone grows to around $77,000. Not because he found a magical investment, because consistent contributions almost always beat obsessing over tiny differences in yield. The same applies to Ethan. His biggest advantage wasn't choosing treasury bills, it was continuing to invest. That's the part people skip because it isn't exciting. Now let's make this practical. If you're trying to decide how bonds fit into your own financial life, here's a simple framework. Step 1. Figure out when you'll actually need the money, not when you hope to, when you'll realistically need it. If the answer is within 2 or 3 years, tying everything up in long-term bonds may create unnecessary risk. If the answer is 15 or 20 years away, longer duration bonds become much more reasonable. Step 2. Separate your emergency fund from your investment portfolio. According to the FDIC, deposit insurance currently covers up to $250,000 per depositor per insured bank for each ownership category. Cash needed immediately belongs somewhere designed for immediate access. Long-term investing serves a different purpose. Mixing the two often creates problems that have nothing to do with returns. Step 3. Build a ladder if you value flexibility. Instead of putting every dollar into one maturity date, spread investments across multiple maturities. Some money becomes available sooner, some later. You reduce the risk of making one giant interest rate bet. Professional investors have been using bond ladders for decades, not because they're exciting, because they reduce uncertainty. And uncertainty is often more expensive than people realize. So let's go back to Marcus and Ethan. They both walked away believing they'd made the smart play. Marcus believed locking in a higher yield guaranteed the better outcome. Ethan believed staying flexible guaranteed the better outcome. Neither one actually ran the full numbers. Neither one asked how interest rates might change. Neither one considered taxes, inflation, opportunity cost, or reinvestment risk until those factors started affecting real dollars. The real trap isn't long-term bonds. The real trap isn't treasury bills. The real trap is making financial decisions based on one number, one yield, one headline, one influencer, one opinion. Money is never just one number. It's always a collection of numbers working together. Yield, duration, taxes, inflation, liquidity, time. Miss one of them, and your conclusion can be completely wrong. That's why understanding bonds isn't about becoming a bond expert. It's about finally understanding the language the entire financial system speaks. Because once you understand why bond prices move, you'll start understanding why mortgage rates change, why stock valuations expand and contract, why banks adjust savings account rates, and why the Federal Reserve gets so much attention every time it meets. It's all connected. And if you're wondering what happens when you combine bonds with dividend stocks, index funds, and cash into one portfolio instead of choosing just one strategy, that's a completely different conversation. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.